Go. Good morning, good afternoon, and good evening. Welcome to the latest episode here at Mark Yu and Huawei Show, episode 61. Stay the course. This is Mark Yu.
And Wawi Santos, good evening, everyone.
Good evening, good morning, and good afternoon again. Well, despite the weather, how's the weather over there, Huawei? You said that you're encountering some severe
Yes,
weather.
severe tornado watch right now along Tornado Alley.
Oh my gosh.
So confirmed touchdown over there at Powderly, just about around 5 o'clock p.m.
Oh man, that's scary. So for those who are not aware, me and Huawei are both healthcare workers here in the state of Texas, and especially where Huawei lives. That's where the tornado alley is. It's close to you said Oklahoma, even Arkansas, right?
Yes,
Yeah.
yes.
Well, stay safe, Huawei. Um, I hope our listeners forgive us if you get disconnected, and hopefully you stay safe out there, Huawei. If any, in any case,
Thank you, Mark.
um, rain or shine, well, I guess we still have to, respect
Do
our commitment and record at least once a week. Um,
yeah.
yeah, both of us here as your show hosts have the intense passion in investing our hard-earned money in the stock market. So, without further ado, we're gonna go ahead and tackle what's up with Wall Street. We have several earnings that we want to dive in a second, but more importantly, we're gonna dive into the weekly Wall Street sentiment review and some fund flows. And just before we dive into the earnings segment, we're just gonna highlight the ongoing slowdown nationwide in real estate. So let's go ahead and dive in. So what a week it has been. Markets dove pretty bad right after Federal Reserve Jerome Powell announced another 75 basis point rate hike. What I don't understand here, Huawei, is we're already anticipating for this. Despite this, the market reacted poorly, thus dragging each and everybody portfolios down in the red.
Yeah, that's right, Mark. This morning there was a little rally going on,
Mhm.
and Collins from the Fed said that they might be easing some of the rate hikes, and then the market just started changing direction, started going downwards, but we still ended up on the green on the
Yeah.
indices today.
Exactly. Yeah, it's kind of like all over the place. Despite that, there's already a predictor, there's already a sentiment indicator, there's already forecast, there's already thousands and thousands of brain waves working on, trying to see how market reacts. But still, nobody can predict where the stock market is going. And now we're going to dive into the sentiment survey, which is done on a weekly basis by no other than the American Association of Individual Investors, which luckily it's for free. So as of a couple days ago, November 2nd, there are even more bullish people at the same day when the Federal Reserve was hiking up rates. Probably this is because they're thinking that the pivot is coming. So for those who are not aware, pivot is when the Fed would hopefully slow down its rate hikes. So if you're, closely invested in, closely following the stock market, um, it's been a horrible year. Everything is down. We've had this biggest sell-off in decades, and still, people are getting more bullish as of last week. As of this week, we're at 30.6% according to the survey, compared to 26.6%, and it's actually the highest for the past 4 weeks. Still below the historical average, but definitely getting on more on the bullish side. If you're gonna take a look at the bearish sentiment, from 45 or nearly, 5 percentage points, nearly half of the surveyed people or investors were down more than 13%, more than 10%, down to 33 bearish sentiment. Those who think that the stock market will be down in the next few months. So sentiment is changing, but the market is still not reflecting any bottom in sight. So fear and greed index, another good indicator right here. We're actually back in greed. We're at 58 compared to previous week's 60. Oh, we're actually still at the greed level. I guess we're at the greed level since last week, Wowie.
Mm-hmm.
And yeah, market momentum, we're still on the bearish or fear side. We're still below the 125-day moving average. Or for those who are not familiar, this is the 4-month average. So it's some sort of a bullish sentiment if the S&P 500 climbs up and breaks this trend, as what it tried to do back in mid-August, but failed to do so. Thus, the sell-off continued until present. The market breadth, or the amount of stocks that are being traded, it's still going on to the positive territory, which is a good sign, reflecting some sort of market activity among investors. The put and call option is still up, and whenever this gauges up, it reflects that investors are buying protection for their portfolios. Those who are buying put options tend to benefit if the stock market goes down. But interestingly, at this point in time, it says greed instead of fear. So what I'm trying to see is, like, when did it start to go down? As on this chart, it looks like we reached a peak around September 28th. So about almost a month and a half ago, when the trend started going down. So people are not as bearish in terms of option trades. And if I recollect this, accurately, I saw an article maybe a couple weeks ago that retail investors are not that much involved now in options trading, probably because they're being suffering a lot of losses because of buying these option trades, because it's really hard to trade options, right, Wabi?
Oh, that's true. Because of the high volatility, they're having a hard time covering you know, their options.
Yeah,
So,
1 second you're green by thousands of dollars, and then next thing you know, you're down. You lost the whole amount of your options value if you're not paying attention to it. So it's quite tricky.
mhm.
The volatility also, while we look at this, it's still down. So not as volatile as one would expect, despite the wild ride that the Wall Street, the S&P 500, Dow Jones, and Nasdaq has been giving us. So what I'm trying to derive here is maybe investors are now used to the sell-off. Regardless, whatever happens, it's still going down. So,
Yeah, kind of
not,
like a investor fatigue. Yeah,
yep,
that VIX was at 25 midday when last
yeah,
time I checked.
true. And right now, it's not far from that. It's 24.55. And look at the past 5 days; it's down nearly 10%. So up or down, the market. That's what the market does.
So looks like we're gonna possibly, a lot of bullish signals right now, but I'm still not banking on it because of, you know, how the market is gonna react. But there's a lot of signals that, the Fed may just do a 50 basis points on their next rate hike, and they raised their target to 5% at by next year, early next year. So it's a higher target now.
Right. So even more tightening that might take place. And despite the sell-off, look, it's been the S&P 500 is down 2.9% for the past 5 days, but still the volatility is down. So that's quite an interesting occurrence right there. The
Mhm.
volatility for the Nasdaq is even lower, down 7%. So despite the sell-off recently in tech companies, we're still showing down on our sentiment, or on the volatility side. So now we're taking a look at the um, dumb money index. So as of September 29, looks like that's the latest data. Yeah, I don't think there's any update for October, so we're gonna skip the dumb money index. So this is a Financial Times article. Um, says here, U.S. ETFs draw almost 500 billion of inflows despite grim. So what's interesting here is despite the sell-off, right? Well, I think we've mentioned this last week as well. We have encountered the first weekly inflow for the past 2.5 months, for the past 10 weeks, as of last week. And this is being supported by this article by Financial Times, which is reputable financial news provider. So as of November 2nd, this article said that the U.S. exchange traded funds, or ETFs, have pulled almost 500 billion in new client money this year. A powerful shift into vehicles despite a historic pullback in stock and bond markets.
Yeah, so definitely a lot of investors now are putting their money back into the market, um, predicting that the Fed will start easing. There's still a strong and tight job market in place, but it's starting to show cracks, especially in the tech sector, which is pretty much hammered by all of this. Of course, that we've been talking about that for more than a month now.
Yep.
But we're starting to see cracks on that jobs data. So
Yeah, going to the industry performance, for the past 5 days, we have at least three winners among the group. Number one is basic materials. Number two is energy. I mean, energy has been really outstanding. I think it's my only savior in my portfolio. In
well, you're
particular, it's ExxonMobil. Yeah, my
yeah,
ExxonMobil is the only one that's floating positive territory for my portfolio.
yeah, energy sector is the only um, green for the
Mm-hmm.
whole year. All the other sectors are not performing very well. ExxonMobil, if you look at its price to earnings, it's still very cheap.
Mm-hmm.
Um, and its PEG ratio is at 0.33. So there's
Oh,
still
wow.
for the 12 months. So it's below one. So it's still got a lot of momentum.
Definitely.
So all sector is doing great.
Yeah, for those who follow Peter Lynch investment strategy, he likes to invest in companies that are less than 1.5 in PEG ratio. So when Wari had mentioned that definitely reminds me of that legendary Wall Street investor. So yeah,
Mhm.
you're right. 0.35, 0.33, it's pretty cool. Pretty cheap compared to its industry of 0.6 according to Zacks. So
Exactly.
at how much is Exxon right now? I don't know. Some stock price as of this evening is around $112. Oh my gosh. I
Yeah, so
remember
it's
when we
relatively
were
cheap
yeah,
for a
we were
12-month
able
peg.
yeah, during the COVID lockdown it went down as low as 20 or 25, and that's when we started buying some, right? While we two
Yes.
years ago. And now it's more than six times.
Mhm.
That's an incredible value return. Look at that. For the past year, it's up 72%. Since the COVID lockdown, oh, it was down as low as $32. It's because since its lowest, it's now more than doubled, 243% for the oil giant.
Yeah.
So other company that we may have, we need to mention just for honorary purposes is Chevron. So that's another really solid oil company.
Mhm.
So energy for the past month is the best performing industry. There are only three sectors, believe it or not, that are down for the past 4 weeks. And number one is communication services, of course, no other than Google, probably Facebook, and the Meta platforms, Snapchats of the world, um, those companies. Consumer cyclical, and of course, no other than technology, the worst performing sector. I guess second worst performing sector since the start of the year. And they're right, Wowie. Only one sector is on the green since the start of the year, and we're already at November 4th. So it's been a horrible year for most
Yeah.
of the investors, especially for those who are invested in technology.
Yeah.
Um,
Kudos to the ones invested in energy, in
yep.
the energy sector.
If you're heavy on oil, and since the start of the year, you never let go. Yep, congrats to you. You did a fairly wonderful job as the whole sector is up nearly 47%. So now we're just gonna briefly mention what's happening on the real estate, particularly concerning Texas. So me and Huawei, obviously we have the bias to discuss Texas because we live here in Texas.
Mm-hmm.
So this is an article that's just flashed this morning. It's this evening, 4 p.m. to a couple days ago actually. This is from Dallas Business Journal. Collapse in Dallas Fort Worth home sales worse than Great Recession. So the title indicates like a panic, almost like they're trying to instigate a panic. But let's look at it closely. Closed home sales in October were down 37% in Dallas and Collin counties, 32% in Tarrant County. If I'm not mistaken, Tarrant is in Austin, right? Or no?
Oh,
Tarrant, I think it's oh
I'm not
no,
sure. It's
Tarrant
still probably
County.
North Texas.
Oh, okay. Tarrant County is involving Fort Worth. Sorry about that. So yeah,
Mm-hmm.
definitely. Title speaks to itself. The Dallas Fort Worth area. So sales, the collapse in sales experienced currently are worse compared to the Great Recession period. That's incredible. Um,
Well, everything is overpriced, right? But they're seeing that the housing price decline won't be nearly as bad as predicted.
yeah, pending
So,
sales set to close this month in November are down 44% in Dallas County, 40% in Tarrant County, and 39% in Collin County. So
mm-hmm.
I guess what we could deduct from here is there'll be plenty of houses to choose from in those areas in the coming months. Inventory will skyrocket.
Yeah, everybody's just waiting for mortgage rates to go down along with home prices when the Fed starts easing. So it's gonna be a crazy market. That's what I'm predicting.
Right. And this just brings into mind what I read yesterday from Bloomberg. Open Door. Open Door used to be a red hot agent or company during the housing boom last year. Now it says writes down home inventory by nearly or by more than $500 million, 573 million being written down. So that's like ultimately
Yeah.
resulting into losses for its investors, for the company. That's a
Mhm.
lot of money to write down. So definitely real estate. If you're a buy and sell investor, this is not the really good opportunity, opportune time to do business in that aspect. Interest rates are high, inflation, everything is high, delays everywhere. Uh, material costs, like we said, inflation, and also salary for manpower, pretty much is up. So I don't think profitability is nowhere in sight if you're a you know buy fixer upper type of investor.
Well, the
So
big
mhm,
lumber company here over north of us here in Arkansas, Oklahoma,
uh-huh,
Weyerhaeuser is doing really good. Um, so there's an uptrend. So there's probably gonna be more home building while the lumber prices are still low. So they're gonna replenish that shortage in homes here, and
right.
this market is just I'm thinking this market is just gonna boom once the interest rates you know changes from a high interest rate to a lower interest rate.
Yep. That's if Jerome Powell decides to let go or at least slow down in hiking rates. But there's no telling. Right now we're in a free market. I guess this is the beauty of it. We see how the market reacts. It might take a while. It might take a quick second to react, like the stock market, which it does automatically the moment some words get released or get discussed. So for Dallas Fort Worth area, the home prices is still higher than last year. So from 350,000 back in September of last year, we're at $399,000. So it's still 49 or nearly $50,000 more expensive. But the thing is, it's slowing down on a month-to-month basis. So saying here, September 399,000, but it's less than 405,000 back in August. So it's slowly going down, the house prices, but it's the what do you call that? The transactions that's taking place. It's not that much anymore. It's down 40%, 44% in some cases. So
Yeah,
this
so in
is
Arizona,
Mhm.
you can see, home builders are shifting and offering big incentives for people to buy homes over there in Arizona.
Right. So this is another very helpful indicator from Redfin. I believe this is the company that's really they know what they're talking about. They're not just not like like let's just say for comparison's sake, like Zillow. Redfin comes out of their studies and what the ongoing market trend is, regardless what it is doing. So Redfin says this was just published today as well. Demand declines ease as mortgage rates steady around 7%. So actually, according to their survey, it says home buying demand ticked up in the last week of October. A glimmer of hope could be seen in the data that mostly reflects a housing market coping with the pain of high mortgage rates. So we're gonna just jump on their very helpful charts. I'm gonna slowly just go on to look for their inventory. So active listings, it's now higher than where it was in 2021. Active listings of homes for sale is up 7% to 845,000, but who counts? So it's better to just observe the percentage rise. We now have 3.3 months of supply available in the market. Remember when we were talking about less than a month of supply?
Hmm.
We're now way above 2021, even way above 2020.
Well, that's exciting news. That means, prices should trend down.
Prices might trend down as well because of high rates and more inventory, right? Homes sold in a median days of 35 days. So back in this is just this year, back in May and June during summer this year, we were actually already looking at the lowest, quickest turnaround in terms of homes being sold at around less than 20 days. So people are taking their time now. They're probably sending inspectors and taking their time and really thinking about diving in because houses are more expensive. You got to pay for inspectors for their turnaround, appraisal as well. So people are taking their time. This is good. This is when rationality sets in and not by, buy blindly and, suffer later. Suffer the consequences later if you really didn't do your inspection. Really good. 7.9% of listings, Wowie, had price drops. This is the highest since the COVID lockdown. This is the highest. If you could see the chart right now for those who are listening, oh my. This is completely an inverse relation to both 2020 and 2021. And
Yeah.
for the home buyer demand index, this is the most important chart, in my opinion. It's now down 33%. So the demand index is now on a slump. We have entered more than the bear market territory. It already lost 33%. So definitely on the downtrend side. So this is a Texas housing market. Median housing price, at least 50% or more, are selling for $355,800. So still below the national average at 13, almost 400,000. So you can still see value here in Texas.
Hmm.
But still, yeah, like what we said, it's trending down month to month, but compared to a year ago, it's still high, 40, 50,000 more. So here we go. This is a CNBC article that we took a screenshot. Wells Fargo, one of the largest U.S. banks here in the U.S., this was published a couple of days ago. Wells Fargo mortgage staff brace for layoffs as U.S. loan volumes collapse. So volumes in the largest bank or one of the largest mortgage banks here in the US, loan volumes is down nearly as much as 90%. So this is not a good sign for those who are trying to sell their house for a profit. I mean, there are other reasons why you want to sell your house. Maybe you just want to upgrade to a bigger house or downgrade to a condo or a retreat house. But if you're trying to get like a optimal price for your home, on average, I don't think you'll get a good deal at this point in time because even banks are now calling, are shutting down their doors for their employees because there's not much business anymore. 90% down. Huge. Another
That's
chart.
terrible.
Uh-huh. Yep. Another chart from National Association of Realtors. Share of first-time home buyers is at lowest since 1981. So 2022 minus 1981, that's 41 years ago. So first-time home buyers are definitely out of the market. I could, in my opinion, they're not risking it or they're not wanting to pay for the high rates, which isn't a good sign if US economy in total is relying on the housing market as well. So definitely not so plush or really a pretty picture there in real estate aspect, right, Wabi? What do you think?
Well, I'm still optimistic that things will stabilize and normalize, and that's usually the historical trend. What we're trying to avoid is a full-blown recession, but there's a chance that we may not get into that.
Mm,
Um, so just um, just thinking about, you know, I mean, everything is just hinging. For me, everything is just hinging on the Fed decision right now. There's a lot of debate as far as, what's causing the inflation, such as energy being, being high, but that's questionable. Um, it's more of a supply problem, I think, and I agree with some analysts that says it's a supply problem. China is the biggest supplier global, and right now China is in a shutdown. But there's good news, and I just want to share that with the listeners. The U.S. audit of the Hong Kong stock market has just been completed today, and you see an uptick on some of these Chinese stocks on that news. So we'll hear more about what came out of that audit.
yeah,
And
Alibaba is up 7%
yeah,
today.
I mean, it's really,
10-cent up as well.
yeah, for today. So let's hope everything came out smoothly on that audit and moving forward so we could start trading, you know, I know trading Chinese stocks again. I know I sold a lot of mine, and just when Alibaba went down, I thought it was on the bottom, but it still went down some more.
Right. It's been crazy ride for Chinese stocks.
Hmm.
Hong Kong Hang Seng Index, like you shared in the group, also is the lowest in decades
Yeah,
in
it's a
terms of
bargain right
valuation.
now. Hmm.
Totally a bargain, but you know, who's to say? We'll see how it goes. Meanwhile, Bank of America sees even more sell-off in the S&P 500. Um, so according to uh, the analysts over there, well, I guess this is a different article. So they're saying there's a big low for the stock market coming next spring, a period between March and May. So we have yet to see the bottom, according to the analysts there, Bank of America. Meanwhile, analysts also in DataTrek sees another 29% sell-off in the S&P 500 from here. So this was just published today. So there's what their hypothesis is that earnings will contract for another 20%. So just doing some math here, 220% declining 20% would be about $176 per share for the S&P 500 as a whole. And if you're going to multiply that by 15 times 176, you would see 2,640 as a target price. And currently we are at 3770. So if you're gonna do some math, at negative 26 from 3740. Well, I guess they already did the math for us. Don't want to do any more math at this point in time. But yeah, we're supposed to see a bottom at 15 times multiple if they get it right, if their hypothesis could be true. So not only Bank of America is thinking that we have yet to see the lows at this point, but also DataTrek. So we'll see if the market and investors could hang in there. For sure, retail investors at some point in time already gave up and now are turning a little bit more bullish, putting some money to work. But if there could be more sell off down the road, come mid next year, then that could definitely, hurt more people. And as a result into a more sell off, which isn't a pleasant experience that we already are experiencing at this point in time. It's very sad. It's very hurtful, but hurts our pockets big time. But all we could do is stick to our stay the course and keep investing if we can, right, Wowie?
Yeah, I agree, Mark. That's the long-term investor's mind, is to stay the course. And you could still think about your strategy when you're investing. One of that strategy is dollar cost averaging. I'm still fully invested, and you could never really time this thing. Listening to what you said about Bank of America's forecast, I agree that earnings will be uh, pressured down moving forward, but there's still a chance that we may have a soft landing, but it's very narrow right now.
Mm-hmm.
Unless the Fed Reserve does something, more what do you call this? More of a decrease in the rate hike. I think. I think.
Yeah. And if you could take a look at the screenshot from Bloomberg's landing page last night, so everything is like the big tech companies are now laying off.
Mhm.
Apple pauses hiring, Amazon frees hiring, Lyft layoffs,
Mhm.
Coca-Cola.
Yeah, my analogy with what's going on right now, this is just like inflation is just like a forest fire. They're trying to hose it down with the rate hike, but you should allow some of these trees to burn down on their own. That's what I'm thinking before you erode the whole forest with all that water that you're pouring on it.
Mm-hmm. All right. Well, we got into our last 5 minutes here in this episode, and thank you guys for, still sticking with us. And while we, I shared to you the news that we have like 3 new subscribers. So
Yeah, well, thank
hopefully
you for
soon.
subscribing. And for those that are still listening to us, me and Mark, we try to do this every week on our own spare time.
Mm,
And please don't forget to click like and subscribe. The like helps with the YouTube algorithm. So make sure you click that like button and
yep.
subscribe if you find value into what we're doing here.
Right. Thank you guys for doing so. So we're just gonna go through this quickly, or as fast as we can understand. So it's been a crazy earnings report this week. So we're just gonna tackle a couple of travel companies. We'll start with Booking Holdings, ticker BKNG. Currently, it's $1,800 a share, 874. Total value of the company is $69 billion. Price to earnings is 19 times forward earnings. So the shares jumped after a strong travel demand, and they actually beat their earnings and revenue estimates, which is a good sign. Because we were already speculating that we are now in a recession, or at least bouncing off of a recession for the past quarter. So for the third quarter, all right, bookings came out with their report, but I don't think we have the numbers right here. So It just says revenue is up nearly 30% or 29% to $6 billion. Which is good. I guess, if you click on their link, it doesn't show their numbers. So we'll pass on that. We'll go next on to Expedia. So Expedia came out with a report. Currently, ticker EXPE, $92.63 a share, $14 billion, a lot smaller than its brother, Booking. Forward earnings ratio is 12 times, definitely cheaper than Bookings. If you're gonna take a look at its report, its stock price actually slid after it reported, as its bookings fall short of expectations. So Expedia missed its earnings estimates despite beating its revenue. So revenue also is strong for Expedia. It's up 22% to $3.6 billion. But it did miss its earnings expectations. So Expedia is negative cash flowing at this point in time, negative 1.16 billion compared to last year's quarter. So not so much impressed in terms of his report. That's why probably investors sold off its stock. It was down 3% when it first came out with this result. So next company, I guess everybody knows about this company now. Been a client, been a customer of them. Airbnb, $96 a share. Market cap $60 billion. Forward earnings ratio 36 times. So they did came out with their report on Tuesday, November 1st. Its stock slump, as it looks like because of their expectations. Nonetheless, I think they beat both of their earnings and revenue estimates, if I'm not mistaken. So let's take a look. So yeah, they beat their third quarter expectations, but still slumped because of their expectations moving forward, some sort of a slowdown. So I guess there's a slowdown unevenly among the travel industry, and I think we're gonna end our episode right here. I guess. So you guys have a good one. Thank you again, and this is Mark.
And Wawi Santos,
You
good
guys have a
night.
good weekend. Good night, guys. Thank you so much, Huawei.
Okay, for those in Powderly, my prayers, and I heard that you all need help. So um, just take shelter, and
Take